I frequently say that capitalism has evolved into creditism because credit growth has become the main driver of economic growth. History shows that if total credit, adjusted for inflation, grows at an annual rate of less than 2%, the economy tends to go into recession. Therefore, MacroWatch closely monitors credit growth, normally focusing on the debtors, who borrows the money. But for credit to expand, there must be lenders as well as borrowers. This video will discuss the lenders and the lenders' sources of funding in order to look at creditism from a different angle. This approach is particularly useful in illustrating that the economy is dependent on credit creation to fund economic growth, rather than on savings. It will show that, as of the end of last year, savings had funded only 20% of all U.S. debt, whereas credit creation had financed 53% of all the debt, with the Fed and other countries financing the rest through money creation. This is important because the heavy reliance on credit creation makes the economy sensitive to interest rates. This helps explain why GDP contracted in both the first and the second quarter of this year, even though the Fed has only increased the federal funds rate up to a range between 2.25% and 2.5% so far. With the Fed intent on continuing to hike interest rates aggressively, it also suggests that the U.S. economy could be in for a much harder landing than most economists currently expect. The video will also discuss the astonishing fact that the Federal Reserve has financed 10% of all the debt in the United States. And it will explain why other countries have lent the United States nearly $15 trillion, financing 17% of all the country's debt. This chart shows total debt and total credit. Total debt in the U.S., in other words, the debt of all sectors of the economy, reached $88 trillion at the end of last year.